Welcome back to the Keiser Report. I'm Max Keiser. Oh, wow, this is a real treat. Let's go to Florida and speak with Carl Denninger of market-ticker.org. Carl, welcome back to the Keiser Report.
Thank you, Max, for having me on.
All right, Carl Denninger. We've got a situation here. The oil price collapse. What impact is this having on the credit markets, and is that negative impact outweighed by the positive consumer impact, Carl Denninger?
Well, it's a very large negative impact because these shale and fracking drillers have issued somewhere between $500 billion and $2 or $3 trillion worth of debt over the last few years, depending on who you talk to. I've seen numbers all over the place. And of course, we all know how accurate everyone is when you see a range like that. It sounds an awful lot like subprime, right? It's contained. It's only $20 billion. And then it turns out that it blows up the world. The other thing, though, to keep in mind is that even in the United States, this supposed consumer positive is outweighed by the fact that you have all this employment and construction that's been going on in the states where the fracking and the shaling is happening, and that's all going to come to a stop. So I'm not at all convinced that this is positive on net, at least in the United States, even for us. And of course, in other countries where you have a consumption-based system and there is no alternative energy drilling going on, it would be a positive. But here in the U.S., I'm not sold on that.
Okay, so you mentioned 2008, and let's roll with that a little bit. So going back to 2008, people were saying, oh, wow, we're making mortgages available to people who don't really have the credit to get a mortgage. They don't have the income for the mortgage. And isn't that great for the economy? Everyone's going to own a home. But in the background, there was this huge leveraged play that was reaching a tipping point, and then it exploded. So my question is, people on the front end of this are saying, oh, wow, gas is cheaper, but behind the scenes is this enormous extended credit bubble tied to the oil price, assuming that it would stay around $80 or higher, and here it is around 50 to 60, and similar to the subprime crisis, is that a fair analogy, Carl?
Yes, except that the sector level impact is smaller. But then again, remember that back in 2000, we had one little sector, namely tech companies with no earnings and no prospect of ever making them, that blew up the stock market. So this sort of thing is kind of the unknown at this point, in that although all the analysts are saying, well, you know, there really isn't that much credit impact other than this little area of high yield, I'm not sold on that because, as you know, Max, these guys like to sell this debt off into various markets, and then people start writing derivatives against it. And we don't know exactly how many derivatives are out there against this stuff. So I think there's a problem there. But the other side of the impact on this is in municipal budgets. You have cities and towns and states even where this fracking and this shale drilling have been going on. They've been putting up new schools. They've been issuing bonds. They've been doing all kinds of spending on infrastructure. And if these drillers go out of business and this becomes an unviable thing to pursue, those bonds have already been issued. That debt is out there and it will have to be serviced. So the negative roll through on this over the next 5 to 10 years, assuming that prices stay down, could be very significant.
All right, so I want to switch gears here a little bit and talk to a little on a slightly different topic. Carl Denninger, of course, is the author of Leverage, which is a fantastic book, and you really dig down into the I would say the entrails of the banking system, looking at the actual MZ and all these other numbers that make up the actual reality of the. Let's talk a little bit about another crisis. The G20 signed on to what they call the Financial Stability Board's Adequacy of Loss-Absorbing Capacity of the Global Systemically Important Banks and Resolution. Okay? Which allows for confiscation of deposits and pension funds. Your comments, Carl Denninger.
Why is it that every time that Wall Street and their minions in other countries start gambling with other people's money, that they manage to put the gambling debts in front of other people's cash? You know, it used to be that deposits were the first claim in an insolvent financial institution, and everybody else had to go to the back of the line after that. And that makes perfect sense, because when you deposit money in a bank, you're not looking at this as making a loan to the bank, even though technically you are. You're looking at them as essentially putting it in a safe deposit box, which of course they're not. So unfortunately, through time, this protection has been eroded. And in the United States, we just had our wonderful Congress allow the trading of these derivatives back under regulated and insured entities, which was removed from them under Dodd-Frank. That was a little, I guess you could call it Christmas cheer for Jamie Dimon that was slipped into the bill that was just passed to fund the government. So yeah, the games are still going on, and we haven't seen any change there.
Right. Well, it's interesting that Dodd-Frank, of course, or any of these pieces of legislation that come after these collapses, then after a few years' time, the banking industry just gets lobbyists to work their way back to positions that were before these reforms. And during that period of time, the amount of debt and leverage in the system keeps on rising. And here's another thing. Congress also restored the derivatives exemption. Can you talk about that? What is it, and what does this mean, Carl Denninger?
Well, that's what I was referring to with regards to the recent budget bill that just worked its way through the House and the Senate. Dodd-Frank took out the bank's ability to trade derivatives in their regulated subsidiaries. Those are the ones that are covered by government deposit insurance, and said you must put those derivative trades into a subsidiary that has no government protection. So if something goes wrong, too bad, so sad, you lose, and that's just the way it goes. Well, Jamie Dimon apparently didn't like this very much, and so he made some phone calls to Congresspeople, and among them and some of the other lobbyists got a provision stuck into the budget bill, which has nothing to do with the federal budget, by the way, that says that it's perfectly okay for the banks to start trading that stuff back under their regulated arms again. So once again, the taxpayer is back on the hook for the gambling debts of Wall Street.
So correct me if I'm wrong, but we had two things happening at the same time. Number one, they made it easier for banks to claim, put depositors at the end, back of the creditors at the end of the line. So the depositors are no longer first in the case of a bankruptcy, which they now call resolution. But in other words, it's a bankruptcy. So depositors are less safe than ever before. And at the same time, the banks have been given the ability to essentially leverage up their derivatives book to even greater levels. And these things are happening simultaneously, correct?
Yes, and the biggest problem with the derivatives is that there's no capital behind any of those. We found that out when AIG got in trouble. They'd written $500 billion worth of derivatives and had no money. So, it's like going into a casino in Vegas and saying, I'm going to bet $1 million on red, but oh, by the way, I don't have $1 million. And then when the number comes up black, then you turn your palms up and say, oh, well, the taxpayer needs to make that bet good. And see, this is part of rigging of the financial system that allows these institutions to report profits. But the reality is that you're supposed to put your own capital at risk when you earn an alleged profit. And that means that when you make a bad decision, you lose your money.
All right, Carl, I want to, this period of 2008 comes up again as a point of reference. Now, if I remember correctly, leading up to the crash of 2008, the stock market was kind of going up and things looked great, but banks were buying insurance on each other. And we saw this in the derivatives market because they knew that they each held really bad securities, and so they were trying to insulate themselves. At the moment, if you look at the credit spreads and you look at the derivatives market, you see that banks are once again kind of buying insurance on each other, but the markets are still trading near all-time highs. Is this telegraphing something to us? Can we read into this that the banks are kind of positioning themselves for something that's not generally known by the public, Carl?
Maybe. But remember that what happened in 2008 was that we found out that none of these guys that were writing this insurance had any money to pay. So this game is really about regulatory arbitrage. It's about being able to go to the Federal Reserve or the ECB or whoever your regulator is and say, a little dodgy, but I have an insurance policy in case something goes wrong. It's not about actually being protected in the event something bad happens. It's about being able to say you're protected. And those are two very different things. It's kind of like buying fire insurance from a company that doesn't have any money, just so you can say you have fire insurance. It has nothing to do with if you actually have a fire.
Okay, so in other words, put it another way, these banks like JP Morgan, they know that their securities that they have in their books are pretty much worthless, but the game is on this regulatory arbitrage game is to try to get Congress and other regulatory bodies to just lower the bar in terms of being able to treat them as collateral or to be able to classify them as something that's either on the books or off the books. So it's completely just gaming the system. They have absolutely no earnings, honestly, made whatsoever. I want to go to my last question, which is that, and talk about the consumer a little bit. The expectations for a better job market help power the University of Michigan Index of Consumer Sentiment to a new 8-year high in December that mirrors the boom years of '96 and 2004. Consumers are very positive, Carl. Are they right? Are they wrong? What can we say about this?
Well, if they're so right, where are the sales coming from? Because the retail sales report, despite the headline, was worse than the same month last year in terms of gains. Remember, we have this little holiday called Christmas when people tend to go out and shop, and that starts right around the end of November because of Thanksgiving. So the retail sales report tells an entirely different story, and the jobs report, while the establishment survey was very positive, when you look inside the household survey, which actually tells you what people really did because they actually call people's homes, that report wasn't positive at all. So we have a series of numbers coming out of the government that all appear to be cooked. I don't have any idea what sort of integrity you've got in this consumer confidence survey and its methodology. But what I do know is that when I look at the raw data, not the seasonally adjusted numbers that everybody likes to rely on, but the actual raw data and compare against last year, say much less previous years, they don't look good at all.
All right, Carl, we've got about 20 seconds, and I just want to ask you quickly, can you give me in 20 seconds a prediction for 2015, Carl Denninger?
I think the credit problems in the oil patch, assuming prices stay low, start to show up in the first and maybe second quarter of next year, and that's when the fun begins.
All right, fair enough. Carl Denninger, thanks so much for being on the Keiser Report.
Thank you.
All righty, and that's going to do it for this edition of the